Myself, Diksha from the Skilling Department at ARTPARK. I'll be your host today. For those joining us for the first time, ARTtalks is a platform where we bring experts from various domains to share their insights on deep tech, AI, robotics, and entrepreneurship. Our goal is to help startups, students, and professionals gain valuable knowledge and stay ahead in the rapidly evolving tech landscape. Today, we have an exciting session on understanding and navigating the capital stack as a deep tech founder. Raising capital for deep tech startups is significantly different from traditional businesses, and understanding how to structure funding from various sources is crucial for long term success. We are honored to have with us Ms. Maya Chandrasekharan, a seasoned expert in venture capital and startup finances. Ms. Maya is the co-founder and managing partner of Green Artha Innovation, a climate innovation and investment firm. She also co-founded and continues to actively run the 500 plus member Women in Investing Network and is a mentor Techstars India, Sangam FLCTD, and with several startups and impact groups. Maya is an expert at scaling companies that change lives both as an investor and in practice. As one of the founding members of Mentera Venture Advisors, she built the education and skilling investment practice. Maya was also a part of founding leadership that scaled babajob.com into India's largest tech-enabled livelihood platform, securing meaningful work over 10 million people in just 7 years. Before we begin, a few session rules. The session will be a 30-minute presentation followed by a 30-minute live Q&A. Please feel free to drop your questions in the chat box during the talk and we'll address them in the Q&A segment. We'll try our best to address those questions, but like later on after the session also you can drop us an email. This session is also being recorded and will be shared for those who wish to revisit it. Now without further ado, let's welcome Ms. Maya on the virtual floor.
Thank you so much, Diksha, and thank you to the entire team at ARTPARK. It's a pleasure to be here. Just give me 1 second while I pull this up. Can everyone see my screen?
Yes, it's visible.
Perfect. All right. Yeah, it's a pleasure to be here. And, thank you for inviting me to talk about this specific topic. I will add a little bit of nuance before I jump in. So as Diksha mentioned, my day job is really working with climate tech founders and helping them scale both through providing capital and also helping them raise the other types of capital that they need to commercialize. Now, obviously, the audience for this conversation is not only climate tech. It's a much broader group of entrepreneurs, but I thought that it would still be useful to talk about what I would call some general principles about fundraising. And many of these, I think, will be things that can be extrapolated across different types of technologies. They are also, I will give a little bit of a heads up. Some of them may sound like they are very commonsensical. That is going to be the case, but it is also a question of lining them all up one after the other to be able to fundraise. I'm going to start off by saying that for everyone who's joined this conversation today, obviously, fundraising is hard. It is something that we all as entrepreneurs, and I put myself in the same role because I have actually scaled a company, that we all have to go through. Some people find it enjoyable, but for most people, fundraising is, I would say, something that is necessary and that has to be done in order for the business to scale. And so really the point of today's conversation and what I'm hoping to be able to get across is that fundraising can be hard, but it does not need to be impossible. There are some general guidelines that we can use, which could be useful through the process. So with that, I'll get started. And as I said, I just want to start by actually setting a little bit of context on deep tech funding to begin with. Now, these are not my own numbers. These are numbers that were shared by Special Invest, which I'm sure many of you have heard of. It's an early stage deep tech focused fund, and they've done some tremendous work in terms of analyzing the market. Just to give us a sense of where we sit right now in India, what the opportunity is and where there is growth. So this is from their most recent report. For people who have not read it, I would highly recommend that you do read it. It's on their website. It's called Special Invest. And this will just give us a sense of where the market is. clearly a little bit of concern because some of the numbers have dropped, but we will get to that and we can discuss that in a minute. Again, I think the big takeaways over here, just for everyone to be aware of, is obviously in India, deep tech is still considered relatively nascent. And therefore, as you can see, especially on the right-hand side, the amount of funding and also the number of startups that are funded tends to be more heavily weighted towards the earlier stage. This should not be a concern for people who are at the early stage or even at that mid stage who are wondering, is there going to be funding available for me as I grow? Because the market is evolving and it is gathering steam. But this just gives you a sense of what is available and therefore how to position yourself. So as I said, I wanted to set that as context just so that everyone knows what is available, what is kind of the playing field, so to speak. Funding quantum, if we compare India with other sort of more developed markets, especially Europe and the US, is obviously low right now. But there is a lot of interest and there's a lot of excitement. And so it is something that is likely to grow. A very important thing to keep in mind is that while VCs across the board, not just sector-specific teams like the special invests of the world, but also what we would call sector-agnostic VCs who invest across, are very open to exploring deep tech deals. There is an education cycle that we have to go through when we're talking to someone who is not a pure deep tech funder, and we'll talk about that a little bit more. And then the one thing that I do want to call out, which was here, is that the market is, as I said, nascent. And so there's still a high level of volatility. What that means is that for you as founders and entrepreneurs who are out in the market, where possible, take a larger round, even if it's your first round, and I'm talking specifically about equity. And if you think that if you're worried about over diluting, the thing to keep in mind is there is still some volatility in the market. So while a lot of folks might say, I'll take a small round now, dilute a little bit, and then in 18 months go back out into the market and raise a larger round, that level of predictability doesn't exist right now. And so it is, in some senses, at this point of time, better to take a larger round if it is available to you. And so that's kind of what I would say would be the big takeaways from where the money is flowing right now and how predictable it is. Here is where we come to the capital stack. And this is a piece that I think is very important to understand and that we at Green Artha feel very strongly about, which is understanding the fact as an entrepreneur, it's very important for us to understand the fact that different dollars have different purposes. What that means is there are different types of capital that are there in the market, and each of them has a different role to play in your company's growth. This visual over here, I think, again, very nicely depicts it. But what we also need to add as nuance to this is that there are obviously additional layers over here, which is that it is not necessarily a linear path that you go from grant to grant plus equity to only equity to equity plus debt. There are also possibilities of playing within these areas. For example, when you come to a point of some growth, you may have a business that is steady and that is in a position to scale. And so that particular business probably needs some amount of equity and a significant amount of debt, whether that is project finance, whether that is working capital, whether that is inventory financing. But that line of business largely needs debt to scale. At the same time, you may have another business that is still, or another business line within your same company that is still within R&D. So for that line of business, what you would probably want to raise is grant funding. What I'm trying to say is, while this is indicative of what types of funding there are, as founders, it is very important for us to be able to understand what the role of each type of funding is, and at any point of time to look at our requirements and break that down. So grant, as we know, is potentially the highest risk. It is where really very little is proven, and it's really about going in and doing R&D. There are obviously some folks in the market right now, largely, from the government side, as you will be aware. There are a couple of foundations that do grant funding. It is unfortunately still an area that is, I would say, undercapitalized in India, but we do hope to see more capital that becomes available there. Equity more is more amenable to risk than other types of funding. But obviously, equity requires that there is some level of a proof point that's already been created. And therefore, equity can come in relatively early, but equity almost never comes in when there is nothing already proven or when it is just an idea. Though we do hear about those stories, I'm sure we've all read them in the newspapers. Those are few and far between. In general, equity needs to come in when something has been, somewhat proven, or at least some, as I said, early pilot, prototype, proof of concept exists. And at the second stage of equity, there are, different types of equity that could be tapped into, including angel funds, friends and family, smaller rounds of funding that are available without going to institutional investors. As the technology or the product becomes more proven, and for many of you, you could even think of this as how the product moves along the TRL scale. Equity becomes much more valuable in terms of actually building it out and finalizing it. And then finally, debt is a type of capital that's available with the least risk appetite. Debt only comes in when everything is proven, when there is a clear business model, there is a clear ability to service, there are cash flows, and even if there isn't actual profitability, there's line of sight on profitability. And all of this is obvious to us, but the reason I'm calling it out in so much detail is because these are things that we need to think about as entrepreneurs when we go out into the market, which is to really align the business need with the right type of business capital. So this is what I mean by funders have very specific mandates, investment returns, and expectations. Grant funding does not have a commercial return expectation, but there's generally an expectation around what gets created in terms of the R&D. Different types of equity funders have different types of market or sub-market expectations. Debt is generally pretty clear, but the level of risk that they're willing to take, as I said, is very low. Now, one thing to really keep in mind is most funders, especially when you come to this point of equity, and I'm talking about like bars kind of 1 and 2, while they're interested in your technology, are most keen to really understand how does this commercialize. They want to understand the business and the market, and that is what conversations need to lead from front and center. That is where they see. So if you think about the grant funder is very excited by the technology. They want to know what is a potential, what can be potentially created from this. The equity funder is most interested in who does this serve, who is the customer, how does this essentially go from being a technology to being a business. And the debt funder really wants to understand how does that business now become viable and service my needs. So these are things to generally keep in mind whenever we are thinking about raising funding. And then the final point is something that I alluded to earlier, which is that even tech funders are not necessarily deep tech funders. And so it's very, very important to not go in with any assumptions that they understand the sector or the customer or the technology. It is your job as your entrepreneurs and as a founders to bring that to them and to present it as a business opportunity. So taking these facts, I wanted to just go over some very, very simple, and as I said, some of these may come across as just more like common sense, but a bunch of suggestions and guidelines that we at Green Artha generally use when we're working with our companies to help them get on the path of fundraising, which I hope will also be useful to you. The first is an obvious one, which is identify your likely funders. Not everyone is going to be looking at the work that you do. Unfortunately, deep tech is still undercapitalized in terms of the number of funders in the market. But there are, as I said, enough sector agnostic funds who will look at one or two deals if it is something where they see an opportunity and something where they're able to broadly understand the market. So the best way to really see is first, obviously, identify your standard deep tech funders, but then also look at other funders and track what's going on in the market all the time and look at other funders who have done anything that is adjacent to your space or who have ever done anything in the deep tech space, which means that they are willing to look a little bit outside their comfort zone. And this journey of identifying your most likely funders, I cannot stress this enough, is one that needs to start 12 months ideally ahead of a fundraise. And, for a lot of folks, that obviously sounds overwhelming. Unfortunately, that is the nature of the fundraising game. It takes that long to build a relationship, especially for something that is in the deep tech space, where, as I said, funder education is going to be much more important. This is not a platform or a SaaS product which your funders are likely to understand all inherently. This is something that's going to take some convincing about. This is something that's going to take some, explanation. This is related to what I was saying before, right? Which is understand the funder's DNA a little bit before you go to pitch, because that's going to give you a good sense of what resonates with them. It's also going to give you a good sense of whether your technology or your product will resonate. There is I would say, there is almost a temptation to go and pitch to everyone who gives you the time to pitch. There is obviously value in pitching to as many people as possible and getting their feedback, but you also need to be careful that you pitch in a very targeted manner. What I mean by that is, if a company has, for example, been to too many untargeted pitches to funders that are not actually a match for them, eventually the word gets out in the market that this company has pitched to 15 different funders and none of them took it through to the next level, which then creates a negative perception, which is hard to overcome. Now, nobody actually then goes into the details to understand the fact that of those 15 funders, 14 were actually not even deep tech and therefore were unlikely to have been interested in this deal. It's also important to understand that from where I sit as a funder, it is almost a given. It is my job, as far as possible, to meet everyone and to give them the time to pitch. So I will almost always say, if something is generally interesting to me, I will almost always say yes. As a founder, it is your job to understand if that is valuable to you, if that is a good use of your time, and if you're likely to get something from that conversation. When I say get something from that conversation, it may not always necessarily be, a next step in terms of pitching towards a fundraise. It could be a next step in terms of a warm introduction to, a more aligned funder. It could be very solid feedback. But it's very important to know that before you go in, so that your time is valuable and you're able to actually get something from the conversation. Before you actually go out into the market and fundraise, and this goes back to my earlier conversation about different types of capital, depending on the stage of where you're at, really understand how much you need, obviously, which is the number that you go out to raise for, but also what it is needed for. Like, break it down into the types of uses, and then you can align it with the types of funding needed. For some of you who are a little bit later stage, for example, thinking about whether you're using or you want to use this money for R&D, for technology scale, for people and operations, or for plant equipment and machinery will have a significant implication on who you're going to fundraise from. And it could be the case that, as an example, you need to raise 10 crores. 2 crores of that is for R&D. Maybe 6 crores of that is for people, business development, technology development. And then the remaining 2 crores is actually to start manufacturing if you have a product that needs to be manufactured. It is generally not a good idea to do that entire, let's say, 10 crore chunk as equity. What you want to be really careful about is to not obviously dilute too much and to very specifically align what types of funding you need for types of purpose with the type of capital that you are raising from.
Birthmark.
There's somebody who's not on mute.
Excuse me, everyone here attending this meeting is requested to put yourself on mute.
विजिबल होता है वो।
Hello.
अरे विजिबल होना चाहिए।
Ready?
Diksha, I think maybe if you are the host, you could also put a couple of
Actually,
people
I'm
on
not
mute.
having
वो
the
नहीं।
host rights. Let me
और कोई मार्क नहीं है
अरे अगर बोल बोल हो गया ना हाथ में कहीं तो
वो तो चला जाता है
ऐसा
मार्केटिंग
नहीं, अभी फिलहाल के चल रहे हैं ना।
मम्मी आप ये डाल दो ना ये मार्क ही हुआ ना आपको आप नहीं
Madhur ji, are you there on the call?
मेरा विजिबल है और वो लाइव
Able
मेरा
to
भी
give the
visible है
host rights to me, or if you're
क्या
able to
लिखता है उसमें?
mute the
रेड
speaker,
मोल
that
रेड
would be
कलर
really
मोल
great.
ऑन राइट साइड राइट चिक अरे नहीं वो कौन से कराएगा
Krishna Singh, please mute yourself. Yeah.
Yeah, I think we're good. Thank you. So as I was saying, the starting point is understanding how much, then for what, and then what types of capital are aligned with that. I'm going to caveat that by saying that this is an ideal scenario. I fully understand that sometimes the right type of capital is not available for you. What I mean by that is sometimes debt is not available in the way that you need it, and therefore you need to take equity. Or grant funding is not available in the quantum that's needed, and so some portion of equity needs to be used towards that. These are, very real life pragmatic trade-offs that will have to be made as you go through the fundraise journey. But it is good to know what your ideal scenario is so that you understand what are the trade-offs that you are making along the way. The next thing to do is when you are meeting the funder, and this is something that I alluded to earlier as well, generally an equity funder cares about the commercialization of your product. While they're excited about the technology, what they really care about is who's the customer and why are they going to buy this product. And so this is something that is very important. This should be this should be the showcase of your pitch. As deep tech funders, I know, a lot of time, effort, resources has gone into developing the technology. It is very often fundamental foundational technology, something that you have built, which you're deeply, proud of. And it is important to obviously talk about that technology, but always from the lens of here is the application, here is a use case, here is a customer, why do they care about it? What is their buying behavior? What has their feedback been? Because that really is making the business case for the product. That is what is going to give an equity funder comfort that this is actually, as I said, moving from a technology to a business. Related to that, I have seen many pitches where, the team talks about the technology at great depth, the efficacy of the technology, the roadmap for how that technology is going to get developed with the funding that they plan to raise. But not all of them have talked about the commercialization roadmap, which is how there's always a TAM, and then there is kind of an assumption of what percentage of that TAM this product is going to be able to address. But actually breaking that down from where the product or the technology is right now in terms of market traction to the 3, 4, or 5 steps that it takes to get to, let's say, 10% penetration of the market is very important for funders to get a sense that, again, this is something that the team has thought about. everyone has a sense that, technologies, deep tech products take a while to scale. And therefore, and this is already, I would say, a little bit of a concern, or it is an area of scrutiny for funders. And so being able to give them a sense that this is also something that you as a founding team have thought about. You have a very viable business plan and a commercialization plan. So commercialization plan, I want to make clear, is different from a business plan. A business plan is an Excel sheet, which is assumptions about how your technology is going to get sold, what that means in terms of revenues, what that means in top line, bottom line, valuation, things like that. A commercialization plan is how you go from manufacturing, let's say 500 units, 500 sample units to 10,000 units to 50,000 units, how you essentially tie in your distribution partners, maybe your maintenance partners, all of the various things that are needed to be able to get to that scale. That is a commercialization plan, or a roadmap. And there will be things that change from what you put out there as a plan versus what actually happens on the ground 1 year, 2 years from now. But what is important is to be able to show that you have some granular sense of how this is going to happen and what are the steps involved. And to be able to show what are the principles that you're using for scale. Everyone expects that business models will change, business plans will change, and also the commercialization path is likely to have some tweaks and pivots, if not a complete change. That is fully expected and taken for granted. But as I said, it's really about showing your thought process along the way. Very, very important. I have been in several pitches where we've asked the founders, so what do you think are the risks for your product? And some founders have come back and said, there are no risks. This is a fantastic product. It really solves whatever the market need is, and I'm 100% certain that it will get adopted at scale. Now, that level of optimism is excellent. It is exactly what you need. If you don't believe in your product, nobody else will. But at the same time, it's very, very important to be able to see what the other risks are. Because again, it is a way for me as a funder to see how you are thinking about the market. Are you seeing that there is a risk from, let's say, a changing policy side? Are you seeing that there is a risk from foreign entrants coming in and being able to undercut you? Are you seeing that there is maybe a supply chain risk because some specific materials that you need come from an area where there are concerns around, the ability to continue to procure? These might seem like things that you don't want to call out because it portrays, the opportunity in a negative light. It's actually the opposite of that. Obviously, we have to play a very careful balancing act of not making the risks seem overwhelming, but it is important to make funders aware of the fact that you, as the entrepreneur and as the entrepreneurial team, have your eyes wide open and are always scanning the market, have a sense of what could be coming, and therefore will have a plan to address it. That's why having a slide or having a section where you talk about the risks in the market in a very candid manner, far from creating anxiety on the funder side, actually provides comfort. This is one that, maybe should have come earlier, but it's essentially, as I mentioned, fundraising takes a very long time. And so this is, I would say, fundamentally the role of every founder, which is to constantly be building the relationship, building networks. Even when you are not fundraising, you are fundraising. And what I mean by that is, even if you've just closed a round and you think that your next round will only be in 12 to 18 months, these things take time. Funders have different cycles. Funders also need to be able to build comfort with your team, your organization, the market. Unless it is a deep tech funder, as I mentioned earlier, this is not something that they automatically and instinctively understand. They might be excited by your opportunity, but they will need to take the time to dig deep and to build their own conviction. They are also not looking only at you as an opportunity. And I speak as someone who previously was an entrepreneur. For entrepreneurs, this is our only company, this is our only focus area. We assume that for everyone else, it's the same. Funders are looking at deals all the time, and therefore these things take time. It is very important to repeatedly meet people and to update, to share. A very, very simple way of doing this is every time you meet someone who shows even a little bit of interest in the work that you do, add them to your mailing list, send out a newsletter. It doesn't have to be a very lengthy newsletter. It could be a couple of pictures and a couple of bullet points every 4, 6, 8 weeks, just so that you're constantly coming back to top of mind and they're constantly saying, that's an interesting update. Okay, so some progress has been made. It does take that much effort. It is really around nurturing the relationship and, constantly reminding people that you're there so that when they are ready as a funder to begin their, let's say, diligence process, or they've now raised their next fund, they're ready to deploy, they know exactly who to come to, and they're also a little bit on top of where things are at for you. This is an important one to present as you are pitching to, especially, again, a non-deep tech funder. And I keep reiterating this point because the fact of the issue is that in the Indian market, there are only a handful of deep tech funders. So for most of you out there, if you are looking to raise, you will probably have to look at sector agnostic and deep tech funders, especially for the sector agnostic funders who don't understand your market as well. It is very important for you to be able to give them examples of other companies. They don't have to necessarily be in India, but other companies, maybe even in other markets, who maybe are doing adjacent work or similar work, and talk about how they have scaled. Again, this gives a sense that while your particular product, technology, or solution might be cutting edge, maybe even a market creator, there is a path to scale. This is what people are looking for. They are looking for an ability to draw patterns and to match what they see with your company versus what they have seen somewhere else, and therefore be able to draw some kind of trajectory internally of how they expect you to grow. So spend a lot of time actually scanning the market. And again, I understand that many of the things that I'm suggesting, identifying funders, understanding their background, identifying corollaries, take a lot of work and effort. These 3 things specifically, so identifying other funders, understanding what their portfolio looks like and finding sort of similar comparables, or what we call comps, are things that other people in the team can actually do from a research perspective. Just pull it together in a little bit of an Excel sheet, or, pull the information together for you as a founder to go through and to digest. The other things are things that the founder has to do, but these things could be done by someone who's supporting you. Even, a really smart chief of staff or an intern could support on these things. Because I understand that time is limited and the founder or the founding team cannot be doing everything. So it's important to really break out what has to be led by the founding team and what can be supported. Another thing that I want to call out over here is not only do you want to find out who are sort of the comparables, it is very important to call out who are the competitors. This is, again, I would say, something that a lot of founders omit doing, generally because they haven't thought about it, but sometimes even intentionally, because there is a fear that if you call out other competitors, the funder will then see that there's too much risk and will back away from the deal. The fact of the matter is that as funders, as I said, our job is to scan the market. We would have seen all of the other players in the market. We will already be thinking of them as your competitors. Therefore, it is actually important for you to proactively frame yourself against them and to very clearly articulate how you are different and better than the competitors. rather than waiting for the funder to ask the question, so how are you different from this company that does this? And how are you different from that company? It is important for you to actually proactively lead by saying, you may think that we are in the same space as XYZ. Here is how we're different. Here is how we are, or we're in the same space, but here is how we're better. And here is why we are more likely to win. That framing and articulation coming from the founder carries a lot more weight than coming as a response to a question. The other thing to also bear in mind when we're thinking about competitors is to not be too narrow. Generally, when we think about competitors, we think about only people who are maybe using the same technology. The fact is, again, as a VC or a funder, I think about from the market perspective and not so much from the technology perspective. So I think about what is a problem statement that the customer has? What is a pain point that the customer has? And what are the 4 or 5 different technologies that could solve for that? As an example from my world, right? The pain point could be water purification. Now, there are multiple technologies that could solve for that. And so as a company, let's say, that is presenting potentially an electrocoagulation method, it is important to not just call out other people who are doing electrocoagulation, but all of the people who are doing any form of water purification, because the customer only has one problem. They don't really care. They are technology agnostic. They only care about solving it in the most efficient and in the most cost-efficient manner. So presenting both comparables and competitors from the perspective of the customer pain point is what will make a lot of difference in terms of articulating where you sit in the market. And then finally, this is one that's really important. It's not an easy one to do, but it is very, very meaningful, especially for folks on the deep tech side, where, as I said, your product or your technology needs a little bit more understanding and a little bit more explanation. Really learn how to tell a story. Learn how to be very compelling in explaining what it is that your product does, and how you can create excitement in the other, in the other party, whether that is a potential funder or a potential customer. One example that I can give of this is, if you think about, and all of you are deep tech funders, if you think about anything on the space side, right? There is something that is almost instinctive within all of us that gets excited about an opportunity that is in space tech. Being able to tell that story in a way that the funder gets excited is a critical skill. It is one that doesn't come naturally to most of us, but it is one that has to be cultivated, because that is how you essentially build out the relationships that you need over the longer term with funders. I have seen, and this is something that we have all seen in the market, that there are some founders who are able to talk about their product in a very compelling and an exciting way, whereas there are others who maybe have a better product but are not able to explain it as well. It is really around the storytelling. And I don't know if this is something that you all invest in right now, but as I said, it is something that I would highly, recommend. And storytelling can come in different formats. It doesn't always have to be standing on a stage, doing a TEDx talk. Not all of us are comfortable with that. It could be participating in panels, as I said, blog posts, articles, the things that we may, as founders, think of as, distractions or a waste of time. We'd much rather focus on building the product. Have to also find the time for that. These are all critical to building a picture and to positioning your company in such a way that it becomes exciting and attractive to a funder. So I think that's it for now in terms of what I had to present. I know that I have gone a little bit over time, but I did want to especially cover all these points, and I'm happy to jump into questions now.
Amazing, amazing. So thank you so much, Maya, for the insightful presentation. Now we move on to the Q&A segment. We've received some great questions from our attendees. It's in the chat box. Let's deep dive right in. So Maya, how would you prefer? Like, should I read it out one by one?
Yeah, I'm going through them, but you can also tell me if I miss anything. Okay, so
Okay,
I'll pick
sure.
one. What are the biggest risks you see in commercialization, industrial regard? Okay. Um, there are obviously several risks, but I think really the biggest one over there is how do you ensure the customer adoption, right? Because when you're thinking about any technology on the industrial side, any innovation on the industrial side, it needs to be integrated with an existing setup. Now, the people who run that existing setup obviously are going to be risk averse because they have already got legacy systems in place which work to some extent. They have outputs and products. They have a system that works currently. So anything that you are presenting to them as, a replacement or as an addition or something that will, as I said, have to integrate with their existing setups, has to be very calibrated in terms of how you talk about the potential downtime, maintenance, parts, any training that needs to happen. Is this something that will require additional capex? These are all things that you really need to think about. And therefore, I think these are obviously not trivial risks. So the thing to really work towards is building for small demonstrations, which give potential customers the ability to try out your product in a relatively low risk environment, understand what's working, what isn't, and then scale. Because it's really about putting yourself in the customer's shoe and seeing what are they seeing as a risk. As a as an entrepreneur, when I present something to a customer, I might say, I don't understand why you don't want to buy my product. It will create this enormous energy efficiency for you. It'll reduce your energy costs, and it'll also make your product that much better. What you as an entrepreneur maybe are not seeing is that the customer on the other end is saying, yes, it may give me all of those benefits, but at the same time, if I integrate this innovation, which is not branded, which is not known in the market, and there is some kind of breakdown in my production facility, how much downtime is that going to result in? How many days of production am I going to lose? What are all of those implications? So it's really about understanding, just as I talked about understanding what funders see as risks, it's also about understanding what customers see as risks and being able to address for those. And I do realize that we are short on time, so I'm going to try and go through the other questions faster than I did with that one. What is the cost benefit analysis of scaling up the business idea? What TRL level is ideal for pitching to? Okay, so let me address that one actually. What TRL levels for pitching to investors? In general, as I said, you would want to broadly align your TRL levels with different types of funding. Some folks can come in, when I say some folks, like an incubator, which provides a small amount of funding, could even come in at idea stage. Most people, would want to come in a little bit later than that, maybe a TRL 2. And then you start to essentially move up the TRL levels as you move up different types of funders. So post that, you, as I said, would probably come in with an angel funder or maybe a group of angels who are ready to come in at around a TRL 4. Equity, your regular, not deep tech funder, I want to be very clear, is likely to want to come in around a TRL level 6 or a 7, where there is line of sight on commercialization and the pathway has been identified to some extent. But there are things that you can do in between that, to find different types of funding. What should be the jobs for a... Sorry, Disha, can you just summarize this question over here from Bhumika?
Yes. I'll just read it out very quickly. What should be the jobs to be done for a founder who has identified a pain point and focusing on creating an MVP? At this stage, assuming he has limited access to user feedback until the MVP gets out, because in deep tech or especially in novel tech, users might not be able to understand its importance until they can experience it. So, what are the indicators which will help the funders realize the founder is working towards a commercially viable product at this stage?
Okay, great. Yeah, so I think, as I said, it also depends on the type of funder. Um, you've identified exactly the right stages, which is that it is really your job as a founder to be able to break down the path of even product development into a couple of different stages. Each stage, maybe one is a rough prototype, then one becomes a more sophisticated prototype, and at each stage identify some users who can add some feedback and be able to really show your potential funder that these are the stages that you have taken, all the way from idea stage, which is just market scoping and understanding what the pain point is, to developing, as I said, a very, very rough prototype, taking that to the same market, getting feedback, refining and iterating in that, going back to the market. Essentially, being able to show the funder that at each stage you are taking market feedback, even with something that is, for lack of another word, half baked or not yet ready, is a critical thing, to be, again, to show that path towards commercialization. And there's no right stage at which funders will come in, but what I will say is that even if you are looking for someone to essentially put money into your company in 12 months, to start building that relationship with them and to start actually articulating to them that, this is how I'm building it out. These are the various stages. At each of these stages, this is the feedback that I've got, and then this is how I'm iterating and refining. Actually goes a very long way to building funder comfort again, because it's not necessarily that there's no right and wrong in this journey. It is more around understanding the thought process and how you as a entrepreneurial, as a founding team, are taking market feedback and baking that into your product. Okay, Sumesh has a question. Okay, Ivy Leagues are not important. I think the most important thing is to be able to call out, one, obviously, this is technology, right? So the efficacy of the technology is the first one. And then equally important, as I said, is the understanding of the market. And having an Ivy League education does not help you understand the customers. Sometimes it is actually it doesn't give you the access to the right customers. So having an Ivy League education is not correlated in any way, I would say, to founder potential. What we look at from kind of the funder perspective is, how well does this team, as I said, understand what the customer's actual pain point is, what is their user behavior, what is their buyer behavior, what are the influences on this customer, and how is that loop constantly getting processed in terms of taking that feedback, iterating the product, or iterating the commercialization of the business model. And what I mean by that is, sometimes the product itself is fine, but how you sell it has to be different, whether it is to a distributor, whether it is through a service model versus a CapEx model. These are things that are important to be able to call out, and that's what makes a difference to a funder. How to approach pre-seed funding or angel investors. I mean, there are obviously several different types of angel investors out there. I'm sure there is an entire database of them. They're all pretty accessible. As I said, our job as funders and investors is to keep ourselves open to new opportunities, to new ideas. So it's obviously, there's a little bit of work in terms of collating that list, filtering it, sorting through it to make sure you find the people who are best aligned with the work that you do, and then creating a very compelling kind of outreach which probably has some aspect of visual, which could be a deck, it could be a video. There's nothing like actually having a product video in there, even if it is still a rough product, to give a sense of what it is that you're doing, and then sending it out to the the people within those teams. In general, your your outreach email will be read. It is a question of whether you've made it compelling enough that people will respond to you. But as I said, reaching out on LinkedIn, reaching out to the email ID that has been provided on that incubator's website or that angel group's website or the syndicate's website is always the best way to go. If obviously you can get warm introductions, there's nothing like it, but that doesn't mean that you have to always wait for a warm introduction. Reaching out by yourself is, I think the first start. I don't want to get into the question of being able to connect with clients, because I think conversation is a little bit more focused on like how you fundraise and understanding the capital stack. I think that's something that I would be happy to talk about separately, but maybe not on this particular call.
Okay, amazing. I think we are done with the questions that were posted over here in the chat box. So Maya, actually, we had few more questions that had come through the registration form. Very quickly, I'll just run it by you. Starting with the first one, the first question we had received was, how does a deep tech founder determine the capital to scale ratio? How does it map to the technology landscape where the playbook is still not established?
I think I addressed this a little bit, and essentially it is a question of what is the use of funds and as I said, the ideal situation is mapping your use of funds with different types of capital. Now, obviously, this person also asked very relevantly, how does it map to the technology landscape where the playbook is not established? The starting point is establishing your ideal, capital mix and your ideal capital structure, which is I need this much grant, this much equity, this much debt, and these different types of debt for the different uses. Then after that, it is a little bit of a negotiation out in the market. Fundraising is both an art and a science. So it is not that, once you've identified it, that those different silos are rigid. There is going to have to be a little bit of flow depending on what's available in the market, who you are able to connect with, where you get a little bit more traction or where you start to see more momentum. Because we are a nascent market, you as founders will also have to be a little bit more creative. You may have to be a little bit more flexible about where you take different types of funding. It is still a market that is in development. So my kind of long answer to that is have an ideal setup and then play within that as close to those boundaries as possible.
Amazing, thank you. The next question is why hardware-based investments are not comparatively funded through, though there is a clear indication from the government of India for making Made in India campaign. Yeah.
Yeah, I mean, I'll answer this very quickly, which is that it's really about it's a question of thinking about who has the mandates to do these types of deals and also the commercialization timelines of, let's say, a hardware product versus a software product. So always when we are fundraising, we have to think about the person on the other side, which is a funder. And as I said earlier, what is their mandate and what are their expectations and what are their timelines to be able to take an exit? At the end of the day, funders give you money because they have certain return expectations, which is a certain amount and also within a certain timeline. And if your product does not align with that, or if your technology does not align with that, and no matter how much they like the work that you're doing, they cannot go ahead and give you the funding. Now, the way to actually work with that is everyone knows that hardware does take a little bit longer. It does not have the same timeline for a growth trajectory as, let's say, software. But once hardware gets to a point of commercialization, it has a very, very strong business opportunity and very, very solid margins. So what founders therefore need to do is, for the early stages, until there is line of sight on commercialization, which, as I said, is what equity investors really are looking for, be, again, creative around how to patch together different types of non-dilutive funding to get to that point of commercialization. So whether it is grant, whether it is small angel funding, whether it is friends and family, it is a little bit harder in the earlier stages, but that's the way that you will have to play it in such a way that you get to the point where commercialization has line of sight, and then funders are more likely to be comfortable coming in because your commercialization fits within their fund cycle and gives them an opportunity to think about where they can get an exit within their fund cycle.
Okay, the next one we have, thank you so much, Maya. The next one we have, how to get government grants and angel investors and pre-seed investors to invest in my robotic startups. Is location of the startup also matters to the funding? So I think the second part of the question maybe you can answer.
Location of the startup. Yeah. I think there are two aspects to location. One, when you say location, I'm not quite clear whether you mean location in India or so within the states and the cities in India, or location within India versus outside India. I'll try and respond to, within India. I would say that in principle, as funders, it doesn't really matter where you are based. When I look at an opportunity, I'm less concerned about where a company is based in the early stages, as long as I have a sense that that company is able to access customers from where they sit and therefore is able to access their market. And B, I also have a sense that that company eventually is going to be able to access other types of capital that it may need to grow, or access the ecosystem that it needs to grow. And that is really where the location consideration comes in. That's why, you sometimes see clustering. For example, like where I sit in Bangalore, you see clustering of startups because there is a very supportive ecosystem that's come up around it. And so as a funder, I have a sense of comfort that, this company is not only going to be able to, as I said, access the right customers, but also access the right capital and access the right partners that it needs. So I think, as I was saying, it's really about being able to prove that point to your funders rather than being able to say that you are necessarily in the startup hub. So there's a question around raising funds for a startup focusing on green hydrogen. Honestly, right now, green hydrogen has a lot of policy push towards it. So I think that there would actually be quite a lot of funders who would be open to this. Definitely anyone who looks at climate tech, anyone who looks at energy, renewable energy, alternative energies would be interested in looking at this. It's really about how you position this as an opportunity. I think this is actually one where it's just a question of actually looking at where have previous deals been done in the energy space and who are the funders and reaching out to them.
Okay.
Yeah, so maybe Diksha, you can go ahead and just share my email ID. Essentially, we'd be happy to look at any company pitches, and then if we think that there is alignment, we will come back.
Diksha, you can check if someone want to just speak here and say a few word or comment.
Yes.
Yeah.
Yes, if anyone has any questions, you can just right away directly unmute yourself and please feel free to ask any questions directly. We are almost at the ending stage of our Q&A session. So I repeat, if anyone is having any further questions, you can just unmute yourself and directly have a conversation with VC directly. Okay, so I will be sharing Maya ma'am's email ID in a few minutes. Considering I think we are at the end of our Q&A session, I'll just very quickly summarize this now. Thank you so much, Ms. Maya, for having this conversation. It was a very fantastic discussion. Big thank you to you and for sharing your expertise with us today. Understanding the capital stack is essential for deep tech founders, and this session has provided a clear roadmap for navigating the complex funding landscape. I'd also like to thank the skilling team, Sushmita, Dr. Ruth, our skilling director, Dr. Sanjeev Srivastava, who's on the call with us right now, and Mr. Mahadev Mandal from the marketing team to help us execute this entire session. And for those who missed any part of today's talk, the recording will be available on ARTPARK's official YouTube channel. Please do subscribe it. Also, do not forget to follow us for updates on ARTPARK's future sessions. If you'd like to connect with our speaker, again, please, you can email us also at skilling@artpark. And since we have your email IDs already, after this session, I'll also be sharing the feedback form along with Maya ma'am's email ID, and we will facilitate it further. So I think thank you all for joining with us today. We will be ending the session now. Happy Women's Day to all of you, by the way, in advance. Thank you. Thank you so much.
Thank you. I enjoyed the session. Thank you so much for having me.
Thank you. Thank you so
Thank
much.
you. Thank you.